The global video game industry is massive, generating approximately $200 billion of annual revenue. About half of this is from mobile games, and the other half is from console and computer games. The industry is only expected to grow going forward. According to a survey conducted by Bain, nearly 80% of people between the ages of 2 and 18 play video games. Teenagers are the heaviest gamers. People between the ages of 13 and 17 play on average 9.5 hours of video games per week. As the size of the gaming industry has expanded over the past few decades, so too is its competitiveness. It's not uncommon for AAA games to cost hundreds of millions of dollars and take many years to develop. And until the game launches, it's very difficult to predict whether it will be a billion-dollar hit or a money-losing flop. In this video, we'll look at some of the biggest video game successes and failures to see how the industry has evolved over the past decade. We'll also look at the emerging trends that will shape the industry for years to come. We'll start off by looking at Take-Two Interactive. With a market capitalization of $36 billion, Take-Two is one of the largest and most successful video game publishers in the world. Take-Two is a holding company which operates 3 different game labels, which operate somewhat independently: Rockstar Games, 2K Games, and Zynga. Rockstar Games makes action-adventure titles, most notably the Grand Theft Auto and Red Dead Redemption series. 2K publishes the NBA 2K series, the Civilization series, and many others. Finally, Zynga makes mobile video games, including Farmville and Words with Friends, just to name a few. The financial statements of video game companies can be difficult to analyze, especially for companies like Take-Two, which own dozens of different franchises. When a company develops a new video game, they incur substantial development costs before the game is released and starts generating revenue. The development cost is not recognized as an expense immediately. It is instead capitalized as an asset on the balance sheet. Once they start selling the game, the capitalized development cost is amortized and recognized as cost of revenue. Let's look at a hypothetical example. Suppose you spend $100 million to develop a new video game. Before you start selling them, you need to come up with an internal estimate of how many copies you think it will sell. If you expect to sell 10 million copies, you need to amortize $10 of development costs for each copy you sell. If you indeed sell 10 million copies, you'll amortize the entire development budget. The amortization is recognized within cost of goods sold. Now suppose that once you release the game, it starts selling way faster than you expected. It's now on track to sell 20 million copies. You need to adjust your amortization schedule accordingly. Now you only recognize $5 of amortization expense for each copy sold. So what happens if the game is a flop? Let's say it's selling far slower than expected and is on track to only sell 5 million copies in its lifetime. You continue to amortize $10 of development costs for each copy sold. If you only sell 5 million copies, you will only amortize $50 million of development cost. So you also have to recognize an impairment of $50 million. The amortization plus the impairment will cover the entire $100 million development budget. You also need to consider microtransactions and DLC. The path of game sales is difficult to predict. A game may sell better than expected in the first year, but then drop off faster than expected in the second year or vice versa. So you may need to make multiple adjustments over time. The accounting can become exceedingly complicated. I do not envy anybody who works in the finance department of any large video game publisher. The GAAP financial results reported by video game companies can be extremely difficult to interpret. So for the rest of this video, we'll ignore the arcane accounting rules and just look at revenue and cash flow. The following chart shows Take-Two's revenue and free cash flow over the past 15 years. Take-Two Interactive publishes dozens of different titles. Historically, the vast majority of their revenue has come from their top 3 franchises: Grand Theft Auto, Red Dead Redemption, and NBA 2K. This chart shows the company's revenue in 3 segments. The first segment is Grand Theft Auto or GTA. Their second segment is their top 4 grossing franchises excluding GTA. In most years, the vast majority of this segment consists of Red Dead Redemption and NBA 2K. The last segment contains everything else. GTA 5 was released in September of 2013. This is within the company's fiscal year 2014, which is the 12 months ended March 31st, 2014. In its first year, GTA 5 generated $1.6 billion of revenue. In the second year, it only generated $300 million. It's normal for a game to generate the majority of its lifetime sales in the first year and drop off quickly thereafter. What's remarkable about GTA 5 is that its revenue increased consistently between 2016 and 2022. Even in fiscal 2024, a full decade after its release, it generated almost $800 million of revenue. To date, GTA 5 has generated $9 billion of revenue. This makes it the most commercially successful video game ever by a wide margin. So what's so special about GTA 5 that it continues to generate so much revenue more than a decade after its release? Shouldn't it be outdated by now? Why does anyone still play it? Back in 2013, Rockstar launched two Grand Theft Auto experiences side by side, GTA 5 and GTA Online. They came bundled together. If you bought GTA 5, you also got access to GTA Online. But while they share the same game world, they're technically two separate games. GTA 5 is a single-player, story-driven campaign that follows three protagonists. GTA Online, on the other hand, is a dynamic, ever-evolving multiplayer experience, where players can explore a massive open world, take on missions, run criminal enterprises, and interact with others in a shared environment. It's a bit of a misnomer to describe GTA Online as a 10-year-old game. Throughout the game's lifetime, Rockstar has released a steady stream of free updates that introduce new missions, vehicles, weapons, properties, and entire gameplay systems. These updates greatly improve and expand the player experience over time. The GTA Online of today is very different from how it was back in 2013. When GTA 5 was released, it sold for the standard price of $60 per copy. But the lifetime value of a customer is far higher than $60. There are many in-game items which you can buy with in-game money. For expensive items, it can take many hours of grinding to earn enough in-game currency to buy them. You can speed up the process by spending real money. These in-game purchases are called microtransactions. In the old days, the vast majority of video game revenue came from selling the physical game disc itself. With the rise of online gaming, the revenue mix has shifted very rapidly towards microtransactions. In 2021, Take-Two's revenue from microtransactions surpassed its revenue from full game sales for the first time ever. In 2023, their microtransaction revenue increased massively. This can be attributed to their acquisition of Zynga. Zynga makes smartphone games. Substantially all of Zynga's revenue comes in the form of microtransactions. Take-Two's other blockbuster franchises are Red Dead Redemption and NBA 2K. They follow similar strategies as GTA. They provide continuous updates to the online experience. This keeps players engaged and keeps the microtransactions flowing in. GTA and Red Dead Redemption are so popular because they provide large open worlds with plenty of things to do, and endless possibilities to explore. Blockbuster games like GTA 5 and Red Dead Redemption 2 have demonstrated stunning longevity, but nothing can last forever. This chart shows Take-Two's net revenue excluding mobile games. This excludes any impact from the Zynga acquisition. The most recent GTA title was released in fiscal 2014, while the most recent Red Dead Redemption title was released in fiscal 2019. Take-Two's revenue peaked in fiscal 2021 at $3.4 billion and has been consistently declining ever since. This declining revenue trend is expected to soon be reversed with the highly anticipated release of GTA 6, which is scheduled for the fall of calendar year 2025. Even when Take-Two was raking in billions upon billions of dollars of revenue, their free cash flow margins were never very high, never exceeding 30% of revenue. In the two most recent fiscal years, their free cash flow was actually negative. The main reason for their relatively low cash flow is that they've been spending huge amounts of money on GTA 6. GTA 6 has been under development since 2014, just 1 year after its predecessor was released. According to leaked documents, the combined development and marketing budget for GTA 6 is $2 billion, making it the most expensive video game ever by a wide margin. For comparison, GTA 5 is believed to have had a total budget of $265 million. The stakes could not be higher. The success of Take-Two Interactive over the next decade depends almost entirely on GTA 6. As the video game industry has grown, so too is the competition. In the year 2010, 328 new games were released on the Steam storefront. In 2024, more than 15,000 games were released. Of course, the vast majority of these are indie games with very low budgets. But every year, dozens of AAA games with 9-figure budgets are released to the public. Major publishers often spend years and hundreds of millions of dollars developing these blockbuster titles. A select few go on to become billion-dollar franchises. But just as many turn into costly flops. In the first part of the video, we analyzed GTA 5, which is the most successful video game of all time. Now we're going to the opposite end of the spectrum with Concord, the single most embarrassing disaster in video game history. Concord was a 5v5 hero shooter with a retro-futuristic design style. It began development in 2016 by a company called Firewalk Studios. Firewalk almost certainly took inspiration from Blizzard Entertainment's Overwatch game, which launched in 2016. Overwatch was a resounding commercial success, generating over $1 billion of revenue in the first year. Overwatch was priced at $40 per copy, and once you start playing, you can continue to spend money on loot boxes, which contain random cosmetic items of varying rarity. Each time you open a box, you have a chance of winning a rare item. The randomness of the rewards creates a sense of anticipation and excitement. This delivers a dopamine hit not unlike the thrill gamblers experience when spinning a slot machine. Overwatch proved that there is a market for multiplayer hero shooters, and the potential for monetization is tremendous. One company that loved the idea of making an Overwatch competitor was Sony. Sony acquired Firewalk in 2023 and continued to fund its development. By the time the game was finished in the summer of 2024, the production budget had reportedly ballooned to $400 million. Sony pulled out all the stops to promote Concord, which they hoped would become a multi-billion-dollar franchise. The game launched on PlayStation and PC in August of 2024. Within the first week, Concord sold just 25,000 copies. At $40 apiece, this generated a measly $1 million of gross revenue. On the first day, Concord's concurrent player count peaked at 700, and only declined from there. Almost nobody was playing the game. Concord's revenue was so minimal that it couldn't even cover the ongoing costs of operating the servers. Sony made the painful decision to shut down the game and refund the purchase price to everyone who bought it. At $400 million, Concord is the most expensive failure in video game history. So what went wrong? If you watch Concord's gameplay footage, it actually looks pretty fun. Sure, it's nothing revolutionary, but it's certainly not the worst game ever. The main problem was not the game itself, but the pricing strategy and competitive environment. Remember that Concord was inspired heavily by Overwatch. They even had the exact same pricing strategy with a $40 purchase price, plus optional microtransactions thereafter. This strategy worked well in 2016, but by 2024 the competitive landscape had changed completely. If done right, microtransactions can be so lucrative that you can make profits on a high-budget game even by giving it away for free. In 2020, Riot Games released a hero shooter called Valorant. Valorant is free to play and generates revenue only through microtransactions. While Riot does not disclose Valorant's revenue, it is believed to be a massive commercial success. Even 5 years after its launch, the game still has approximately 5 million people playing at any given time. The success of Valorant and similar titles caused a major shift in consumer expectations. It became expected that multiplayer-only games with microtransactions should be free to play. This was so much the case that even Overwatch had to switch to a free-to-play model with the launch of Overwatch 2 in 2022. By the time Sony acquired Firewalk Studios in 2023, it should have been obvious that the $40 price point was not going to be viable. Why should anyone pay $40 for Concord when they can play Overwatch 2, Valorant, and many other hero shooters for free? The epic failure of Concord had little to do with the technical aspects of the game. It can instead be blamed on Sony's arrogance and failure to understand the rapidly evolving competitive landscape. While we've spent the majority of this video talking about console and PC games, the fastest growing part of the industry is actually mobile games. Not everybody owns a gaming console or gaming PC, but almost everybody owns a smartphone. As we can see in this graphic from Visual Capitalist, mobile gaming revenue has skyrocketed over the past decade. In 2020, mobile games generated $85 billion of revenue globally. This is more than PC and console games combined. Mobile games are typically more casual and developed on much smaller budgets compared to console games. Because they're relatively easy to produce, the market is flooded with competition. Consumers have tens of thousands of games at their fingertips, all vying for attention in crowded app stores. In such a saturated environment, how can a developer hope to make their game stand out? In this section of the video, we'll analyze Playtika, which is one of the largest publicly traded companies that focuses exclusively on mobile gaming. Playtika owns a portfolio of about a dozen mobile games. Their games fall into two categories: social casino games and casual games. Social casino games are virtual slot machines that use in-game currency instead of real money. Players spend virtual coins to spin the reels, and winning combinations reward them with more virtual currency. While this currency has no real-world value and can't be cashed out or used to buy anything tangible, players can purchase additional coins with real money if they run out, creating a loop where spending fuels continued play even without the chance of a real money payout. This begs the question, why would anyone spend real money for a chance to win fake money? It seems like a lose-lose proposition. These games mimic the sights, sounds, and suspense of real slot machines, delivering dopamine hits through unpredictable rewards and flashy jackpots. Players are drawn in by a sense of progression, collecting chips, unlocking levels, and competing on leaderboards. On a psychological level, it can provide an experience similar to a real casino, despite the fact that you can't win real money. Playtika's casual games are very simple, requiring little or no skill to play. For example, one of their most popular games is Dice Dreams, where you pretty much just roll dice. Another one of their casual games is June's Journey, where you go around a fancy house looking for stuff. Casual games are meant to appeal to a wide audience, including people who don't play console or PC games. Casual mobile games provide a relaxing way to occupy yourself and kill time. All of Playtika's games are free to play and rely exclusively on microtransactions for revenue. You can spend real money to unlock various items, reduce your cooldowns, etc. When you play one of Playtika's games, be it a casual game or a social casino game, you will occasionally see pop-ups trying to convince you to spend real money. Playtika employs teams of data scientists who constantly monitor the success of these in-game promotions, and regularly adjust them to maximize in-game spending. In recent years, their main focus has been to maximize the percentage of players who spend real money in-game. In this, they have been very successful. In 2019, on any given day, approximately 2% of players spent real money. By 2024, this had increased to almost 4%. When somebody does decide to spend real money in one of Playtika's games, they spend on average $22 per day. The mobile gaming market is extremely competitive. The Apple App Store and Google Play Stores are saturated with tens of thousands of casual games. The only way to build a player base is with direct response advertising. Playtika uses digital advertising extensively. They place ads on Instagram, YouTube, and TikTok. They even place advertisements within other mobile games. Advertising is Playtika's single largest expense. In 2024, they spent $705 million on advertising, which was almost 1/3 of their revenue. That same year, they spent $403 million on research and development. So they spend almost twice as much on advertising as they spend on actually making the games. Casual games have very high attrition rates. Because they are so casual, players don't take them very seriously. They will eventually get bored or switch to playing other games. Playtika finds itself in an endless cycle where it needs to constantly conduct paid advertising campaigns to attract new users so as to offset the churn of their existing player base. And this is a battle they look to be losing. Their number of daily active players peaked in 2020 at 11.2 million. By 2024, this has decreased to 8.1 million, representing a decline of 28%. This is despite the fact that they even did 2 acquisitions during this period. The decline in players has been partially offset by more aggressive monetization. But since 2022, the company's revenue has started to decline gradually. Playtika is essentially milking all the cash it can from a declining base of players. Investors have grown skeptical about the long-term viability of this strategy. Since going public in 2021, Playtika's share price has declined by 85%. Alright guys, that wraps it up for this video. What do you think about video games? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.